are going to be talking about some different options for accessing capital for cooperatives. And we have a lineup of 4 people. So what we're going to do is have about 8 to 10 minutes of presentation from each of our 4 experts. First up is Sarah Bauer, who's with Merchants Bank. Then I will be speaking. I'm from the Cooperative Fund of New England. So we're going to start with banking. Then I'm with a mission-based nonprofit. And then Mike Pieciak is going to speak about financing options along with Adam Trott. And Mike is with, tell me the name of the agency. Where are you?
He just stepped out.
You just stepped out.
Department of Financial Regulation.
Thank you. And then Adam Trott with the Valley Alliance of Worker Co-ops. And then we'll have quite a bit of time for Q&A at the end. So if you could just hold your questions, unless you have a quick one so we don't get behind time and we get to hear from all of our presenters, that would be great. And we've been working on technology. Are we all set with that?
So there's one more to come, but we're fine to start.
Okay, great. So I'm going to have each of our speakers introduce themselves. And first up is Sarah, and it's my pleasure to introduce Sarah Bauer.
Thank you. As Betsy said, I'm a commercial lender with Merchants Bank. I'm based in South Burlington. I have a portfolio of all sizes and ranges of commercial customers. So some of them have a couple of truck loans with us. Some of them have millions of dollars of term debt, acquisition debt, lines of credit, and everything sort of in between. My piece is probably the most standard and straightforward because commercial lending is pretty straightforward. It's really hard to give you an average transaction or an average rate or an average structure because every single one of your companies is different and everything that we would look at to try to do for you would be different. But I'm going to walk through a couple things that might be kind of similar for all of them. And look what I learned today. Wow! Even on the screen, it's a touch screen. I'm going to stand over here. The one thing you should know about commercial lending is that commercial banks, we are senior secured lenders. So that means that if you have a couple different lenders in your transaction or that are lending to your company, a commercial bank tends to come first. We get paid back first, and our loans are almost always secured. So we're going to look for collateral. Just like when you borrow on your home mortgage, the collateral is your house. We're going to look for assets that are going to back up our loan. So the good thing about that is that we are also frequently the lowest cost provider of capital. And so that usually leads to, so what is an average interest rate? What are you going to charge me? And that's a really tricky question because right now in the market, the range for commercial lending, the rates are kind of all over the place. I have some borrowers who are borrowing at under 3%, some even under 2.5%. And then they go up from there depending on the profile of your company and the risk and the length of the transaction. Some go up over 5.5%. Average maturity and amortization, it's hard. That's also hard to put an average on. We have some lines of credit that go for a year, and then we also have term loans that go for average on with a 5-year maturity and 5, 10, 20-year amortization. It kind of really just depends on the specifics of your transaction. In general, one thing to keep in mind is if your co-op or your company is borrowing, a commercial bank generally will not lend for 100% of the transaction. It's more common for us to usually look at financing about 75%. So whether you're buying a company, buying a truck, buying a building, we're usually around 75% of the total transaction cost. So you'll be looking for some other source to cover that other 25%. So the things that we're going to be looking at if you come to us looking for a loan are up here. The first one we look for is cash flow. So we're going to look at your historic cash flow and also some projections to see, has it been consistent? And more than anything, is it adequate to cover your debt service? So your payments to us and any other lenders that you owe money to, including capital leases or anything like that. We usually like to see that your cash flow can cover those annual debt service payments about 1.2 times. It's sort of a rule of thumb that most of the banks will use. As I mentioned, we're also going to look for collateral. So that would be any of the business assets, ranging from receivables, inventory, equipment, real estate. And then we discount that, different percentages for different types of collateral, and then our transaction value will be based on that. If there are any individuals who are going to own 25% or more of the company, we'll usually look for them to guarantee the debt. In some of the changes in ownership, you may not have any significant owners, but if there are, that's also something to keep in mind. And the other thing we're going to look for when you're applying for a loan is going to be your business model. And we basically just want to know about your company. What's your industry? What are the trends? How long have you been in business? If you're going through a change in ownership, a conversion to a co-op or an ESOP or something, what's going to happen to your management? Are they going to stay intact? Is somebody new coming in? We'd like to know how things are going. Sometimes we see these as a printed booklet. Sometimes this is just information we get by talking to you. The things that generally a bank is going to ask for to look to see if we can get a loan approved for you are all listed here. Generally, we like to see 3 years of tax returns or financial statements. That includes a balance sheet and an income statement. If we're in the middle of the year, we'd like to see financials through our most recent month end. Business plan with projections, like I said, if that's available. And if you do have any significant owners, we're also going to ask for their personal tax returns and a personal financial statement from them. And depending on the transaction and what your assets are, we might also be looking for an appraisal of the collateral. So one thing to keep in mind is if there's real estate involved and we're going to need an appraisal, you should order that, ask the bank to order it. If a company orders an appraisal by itself and then tries to go to a bank for financing, federal regulations say that we can't use it. I've seen some borrowers get caught and they bring an appraisal. I'm like, I hate to tell you this, you have to pay for another one. So that's just something to watch out for. Also wanted to mention some other structures. Sometimes we do all of the financing for a transaction. In other cases, we look to partner with somebody else. We frequently work with VITA and SBA, either under the 504 or the 7A program. There can also be other layers of debt, whether it's seller debt or shareholder debt. And we also work with other organizations. USDA, I know VEOC, we did a transaction where we partnered with a commercial bank and also Betsy's group, CFNE, so there are sort of different layers of debt. Some of the advantages of doing this is sometimes a commercial bank can't quite get comfortable with doing the whole transaction. So by working with some of these other groups, especially VITA or SBA, sometimes we can get the financing amount from 75% of your transaction up to 90%. So it has some advantages. Also with the SBA 7A program, under certain circumstances, SBA will guarantee the loan for the bank. So that adds some credit support where the bank might not be willing to do it on its own, but with one of these we might be able to put something together. Some things to watch out with these two, there are additional fees involved with those, and depending on your transaction size, they can add up, but sometimes it's still worth it because you can get your transaction financed. I think that's all I have.
Boy, you are right on the money.
Oh.
Great. I'm timing us all, so we.
I was waiting for that.
Yeah. Great. Thank you.
You're welcome.
All right.
Who's next?
I'm next.
Yeah, if anyone wants to grab a seat, there's a couple chairs in the front.
Hello again. What's apparent already is that oftentimes co-op financing is a variety of lenders coming together. So what we want you to walk away with is, and you can mix and match these various options. And I'm going to do a couple of case studies as part of my presentation. So I've never used this before either. This is so cool. If I can make it go. Here we go. So the cooperative fund is a nonprofit entity. We're something called a community development financial institution, which means we are a mission-based lender. We exist to support community development, and in particular, co-ops. So we will lend money to any entity that is democratically controlled. So co-op, a nonprofit organization, and we have a preference to serve low-income communities. So we lend money. We also are a place for people who are looking for an investment that reflects their values. So we have a large percentage of our funds come from individuals and institutions that want to support the development of co-ops. And then we get co-ops hooked up with the proper resources to get the support they need to come up with their business proposition. This is our service area, and this speaks a little bit to where our money comes from, and I find this a really interesting, this is our pie chart right this minute, and you can see 42% of our money comes from individuals. I'm an investor, and I know there are other investors in the room who really like what we do and want to support that work. My second favorite slice of the pie here is co-ops. 9% of our money comes from co-ops, and I guess if you stand in front of it, it does it too. So for example, City Market Onion River Co-op has borrowed money from us over the years, and as they've progressed as a business, they've had reserves, and they have invested some of those reserves back into the co-op fund. So in the spirit of cooperatives, helping cooperatives, which is one of the cooperative principles. Okay, there's a little trivia question. Which cooperative principle is that? 6? Very good. Very good. Okay, and who we lend money to is food co-ops. Is a huge percentage of our portfolio, and that's really interesting because co-ops go through all sorts of cycles. If you look at the history of co-ops over time, and there's been a huge upsurge in the development of food co-ops, and which continues right now. So we have a lot of our funds invested in food co-ops right now, and quite a bit in worker co-ops. And you can see there's other ones. Here are a couple of our borrowers, just to give you a little bit of a story. And this, I have to, boy, it's just motoring along. This is Deep Root Organic Co-op, which is the marketing and distribution co-op up in Johnson, Vermont, that distributes and markets vegetables. This is a fishing co-op where purportedly this tuna was a very high-end tuna and paid for the fisherman's daughter 1 year of tuition at college. Yeah, it was shipped immediately to Japan for some very fancy sushi. Consumer co-op mentioned the food co-op, and then this one is a resource material co-op that sells in Boston. Okay, so I'm just giving you a little bit of background. So how does a loan fit into a capitalization plan? In addition to, as Sarah was talking about, there being a variety of sources, typically a loan is just part of the financing for a co-op. So one thing that we sometimes do, my wife keeps jumping ahead, is that we'll commit early. As a mission-based lender, the co-op fund comes to the table wanting to say yes, provided the proposed business proposition is a sound one. And we're happy to come in first and say, yes, we will commit to this as a way to make it easier for other lenders to come in if for whatever reason we can't finance the whole deal. The other thing we are very happy to do is to sit down with the borrower, make sure that their application looks complete, and if they need any help, so for example they need legal help or they need some help with their business projections, we can either help or make sure that they get the right advice. So all the things Sarah talked about as far as the criteria, we too are looking at the same thing. Just like a bank, we want to make loans that are good loans. Remember those investors? They all have faces. They all have dreams. We need to pay our investors back. And whenever we have any bump in the road with our loans, I will go and sit down with that borrower and say, how can we make this work out? It really matters that you pay us back. And this isn't just about somebody's bottom line. This is about real people's money that they put on the line in support of cooperative development. So we typically do business loans 1 to 7 years. We can do custom repayments. So if you're a farmer and you have a downtime during part of the year, we can structure the loan that you have interest only, whatever makes sense for your business. And then we also do lines of credit. And we will lend money for just about any purpose that's legal. If someone's asking anything, I'm like, yeah, as long as it's legal. And it contributes to the evolution of the business. What we're looking for is, these are characteristics that the bank, any bank, and we look at, what's the capacity of the organization. And one of the things that's really wonderful about co-ops is they have great resiliency. They tend to do better during downturns. If you look at what happened with food co-ops, for example, during the recent recession, many of them continued to have single, if not double-digit growth. Now a lot of them are moving down to more of a stable, but that looks a whole lot better than what we saw in a lot of industries, business structures where there were precipitous losses in sales and profitability. We look at the capital structure. We're looking for cooperatives to come to the table with some assets, and that's the equity share and making sure that owners are coming to the table with money. We're also looking for collateral. We try not to do personal guarantees. However, we are a collateral-based lender, so sometimes we do that because we need to have collateral coverage. And we're looking at character, and this is how does the group work together, whether it's a worker co-op, how does the group meet? And that's one of the things I'll do is I'll go down and sit with folks and really get a sense of how the group works together, what's their governance structure, what are their bylaws, how do they communicate with each other, et cetera, and what are the conditions in the marketplace. So collateral can be a variety of things, and we are willing to be completely flexible about this because the way I look at it, we want, there we go, thank you. We want to wrap up our comments. So we will take stuff, real estate, inventory, accounts receivable, promises. We'll take stuff, promises, and we will do personal guarantees, as I mentioned before. And I'm just going to mention quickly this case study. This is a co-op called Yard and a Half, just to give you an example of how a co-op might be structured. So this is a worker co-op, and it was a 25-year-old business, and this was their financing package at closing. So you can see the buyers or the worker owners put in $62,000. They got $5,000 in contributions, so that was their equity, and then they got debt from us, the seller, the owner who was selling the business, and then families and friends. So it was a package, and coming up with the total financing. I'm going to stop now and might make some friendly amendments later, and I'm going to turn it over to Mike.
Well, thank you,
Get out of
Betsy.
your way.
How did this thing...
There's a little arrow that's going to come up for you.
Great, thank you. Well, I'm glad to be here. I'm glad to see we had such a great turnout about this subject matter. I think it's important. People, small businesses, it seems, are craving capital, craving unique ways to get capital, alternative ways to get capital. As I've gone around the state, there's been great turnout at events that are focused on small businesses and the ways that they can grow and the ways that they can get the money that they need to hire new people and grow their business. So I think we're seeing that here today as well in a different capacity in terms of cooperatives, but all the issues are pretty much the same. So the thing that I want to talk about today is crowdfunding generally, and then specifically how we're enacting crowdfunding here in Vermont and how it can be a tool for small businesses and cooperatives to raise money, to grow, and to expand and hire people and help the Vermont economy and help us all. So if I do this correctly, first of all, I'm from the Vermont Department of Financial Regulation. So as a background, we regulate insurance companies, banks, captive insurance, and then securities. So securities are essentially things that people can invest in and people that give investment advice. Those are the industry that we regulate. I'm in charge of the securities division. We have basically a two-pronged focus. One is to weed out fraud in investments, but the other is to facilitate the efficient formation of capital. And we take both of our charges very seriously. If we focus too heavily on one, it's really to the detriment of the other. So we really focus on making sure that fraud in the marketplace is weeded out, and people that take advantage of investors are severely taken care of. But then we also want to make sure that small businesses have all the tools that they need to be able to raise money, as I said, to help grow their businesses. So just a very brief background of securities laws. Securities laws started in the early 20th century in Kansas. It's called the Blue Sky Laws. People are probably somewhat familiar with that. Essentially, there were folks from New York and other metropolitan areas going through Kansas and other rural states and selling very speculative securities that farmers were investing their entire life savings in. Obviously, they were worthless. Farmers were taken advantage of. Kansas came up with this model of requiring securities to be registered at a central depository. That was probably the Secretary of State's office at that time, so that people knew that an investment was registered, was secure, was safe when they were investing in it. And that's basically the model that we have now. All states adopted Blue Sky Laws. In the 1929 area, that we had the Great Depression. The federal government afterward responded with the Federal Securities Acts as a way to regulate securities on a federal scale. So now you have to comply with both state and federal securities laws when offering investments to folks in Vermont or elsewhere. So the basic idea of crowdfunding is that instead of seeking a large amount of money from a small group of people, like venture capitalists, equity, private equity firms, things of that nature, you're seeking small amounts of capital from a large group of people, $10, $100, $50. And we see that in things like Kickstarter and Indiegogo, but then also now in equity crowdfunding as well. And this other main tenet of crowdfunding is this idea of the wisdom of the crowd. So the thought is that if you are going in by yourself into an investment, that the crowd will protect you in the sense of they will be weeding out offerings that are fraudulent. And oftentimes there's a minimum amount that a company needs to raise. So if they don't raise the minimum amount, your money's not at risk. And it's only put at risk when other investors come along with you. And then this last point about the democratization of capital. Previously, only certain people could invest in startup businesses and businesses that have a potential to grow and grow quickly. The democratization of capital allows any investor, Main Street investor, to invest in businesses that have high growth potential, or even just local businesses that they have a social responsibility and they want to engage in that. So I mentioned Kickstarter, and Kickstarter, how many people are familiar with Kickstarter? Probably everybody. So there's two funny stories that sort of demonstrate Kickstarter. One is this potato salad story. So there was this guy that wanted to raise money to make potato salad, right? And he had a $10 offering. That's how much money he wanted to raise. And he wanted to buy the mayonnaise and the eggs and all that sort of thing and make it for himself and eat it. And he raised $55,000, right? So what was he going to do with all that money? He made a potato salad like promised, and then he threw a potato salad party in Seattle, Washington, with the excess of earnings. So that's sort of a funny example of how crowdfunding is sort of, people think of it as not being ready for prime time or something. But then there's this other example of Oculus Rift, which makes 3D goggles. And they did a crowdfunding campaign on Kickstarter, raised $2 million, but then 1 year later were bought by Facebook for $2 billion. So it was 145 times return. So if you had invested $300 in the company instead of getting a $300 pair of goggles, you would have made $47,000 on that investment, just as an example. So, that made people think, well, maybe this is a little bit more mainstream. Now we see equity crowdfunding at the federal level, which hasn't been enacted yet, but states are coming up with state-based crowdfunding, Vermont included, as an opportunity for folks to invest. So this is just a historical background of investing in Vermont. In the 1980s, a number of businesses that you'll probably recognize here did intrastate crowdfunding offers. They weren't called crowdfunding at the time, but they were intrastate offerings. Vermont companies for Vermont residents. Ben & Jerry's was one of the first, very well-known, Catamount Brewery, Earth's Best Baby Food. And something happened along the way after the 80s. We didn't see as many of these offerings. Companies weren't participating. Probably bank lending was good. But we wanted to take a hard look at why this was. And we saw that since 2000, what we call VSBO, which is the Vermont Small Business Offering Exemption, which allows Vermont businesses to raise money from Vermonters, that there have only been 14 offerings since 2000. And we said, why is that? What is the problem? And we noticed that the regulation was outdated and there was general lack of awareness among the business and legal communities. So we went about to change that. In the last summer, in June of last summer, we revised substantively every prong of the regulation. Now a small business can raise up to $1 million from Vermonters, $2 million if they have audited financial statements. There's no longer a cap on the number of Vermonters that can participate, so you can raise it from any number of Vermont residents. There used to be a 50-person cap. So I like to say that you could raise $1 from 1 million Vermonters, but there's not 1 million Vermonters, so you have to raise it from like $2 from 500,000. And then there's an imposed limit on non-accredited investors, sort of Main Street investors, non-wealthy individuals that can invest only up to $10,000 in an offering. If you're accredited or wealthy, you can invest whatever amount you see fit. So the other thing that's great about the new BSBO is that there's lessening of restrictions on general advertisement. So you can use social media, you can use the website, your website, in a way that's particular. I'd advise that you contact us so we can give you more information about that. So it's not just your friends and family, it's not just your neighbors and colleagues, it's people all around the state that you may never have had a connection with that may find your social mission interesting or your business model interesting and want to participate and invest. So we've seen interest since BSBO, since we passed it in last summer. We've had 5 offerings. So we had 14 in 14 years, and just in the last 9-10 months, we have 5 offerings. So we do see an interest in people participating. Some really varied companies. One of them a cooperative that did a debt offering. So again, bringing it back to the cooperatives here, it's a mechanism that cooperatives can use, mostly when they go outside of their membership, because there is an exemption for cooperative members, both for their equity investment and then seeking further investment from them. So it's really when they're going outside of their membership or they're doing a specific debt offering to their membership is when the BSBO could be a tool for cooperatives. And I think I mentioned that here. So many states have exemptions for cooperatives. In Vermont, whoops, did it go back? So in Vermont, again, the exemption is that when you're offering it to your membership, you have an exemption from securities laws. But again, that's only a Vermont exemption. You still have to worry about the federal securities laws. And then just 2 takeaway points as well. Main investor concern, main business concern. If you're an investor, you're always concerned about your liquidity and your diversity, right? So you don't want to invest more cash into a business like this or any business that you can't get the money out of in case you need it. And you want to have diversification. So you don't want to invest all of it in one basket. You want to invest in a number of BSBO offerings, a number of crowdfunding offerings, or a number of alternative investments, and not to limit yourself that way. And then also for the business, you want to really think about, do you have the time to go out and market yourself? There's a couple of folks here that are trying to maybe take this concern off the table with a new venture called Milk Money, which is a very interesting endeavor. But do you really have the time to go out and market your offering? Do you have the time to follow up with the tax requirements that are necessary? Do you have the time to deal with the shareholders when they have a concern, a problem, a quarterly newsletter, whatever you're going to do to communicate? So that's a real consideration to take into account as well. And I think that is the last slide, so I'll turn it over to Adam.
Great,
Yeah.
thank you.
Good afternoon, everybody.
Hi, Adam.
So my name's Adam. I'm working with the Valley Alliance Worker Co-ops. It's great to be up here with all these other people. I feel like this is a really nice spread of different kind of financing options you have. What I'm going to talk about really is how co-ops themselves can participate in financing of co-ops. A little bit of some history about what other co-op complexes are doing. So I've been working with Collective Copies, a worker-run collective in Western Massachusetts. It's printers for 11 years. I've been the staff for VOC for 5 years. And I'm also on the board of the Cooperative Capital Fund, which is a sister fund of the CFNE, which is higher risk equity-like capital. So I'm just going to try to ask a couple of questions. What are other co-ops doing to try to participate in development? How can we use the co-op model itself to sort of guide how co-ops can be involved? And then what is our fund about? Who hasn't heard of Mondragon here?
Has not.
Yeah. You got it? Just a couple? Okay, great. So perhaps I did too much. Mondragon is a system of worker cooperatives in the Basque region of Spain, but they're also hybrid cooperatives that really are getting together and they share surplus. And they are the biggest system of worker co-ops in the world. They've got universities, hospitals, education, later high schools, high tech. There's a lot going on there, and I think that's one of the contributing factors is that they had surplus from other co-ops to go to long-term planning, education, and innovation. How about the Emilia-Romagna region of Italy? Who's heard of them? Yeah? Okay, great. So this is wonderful. So co-ops in Italy have a lot happening in this one section that's perhaps about the size of New England. There's 7,500 co-ops, 2/3 of those are worker cooperatives, and they themselves wrote a law in the early 90s to say, if you're a co-op in Italy, you have to contribute 3% of your surplus to a development fund. Now there's conservative funds, there's Catholic funds, there's leftist, there's social, it doesn't matter what one, but you have to contribute. So that's just a little bit of an example from around the world. I wanted to highlight two of the 7 cooperative principles here. One is member economic participation. That's just to say, co-ops are ourselves encouraged to participate in development, whether development, education, etc. And here it says setting up reserves, part of which would be indivisible, benefiting members, and developing cooperatives, etc. Another one, of course, is often cited, cooperation among cooperatives. So that is that we, cooperatives themselves, succeed more when we work together through regional, national, and international structures. Then a couple of the values are self-help, responsibility, democracy, equality. To us, when we were forming the Valley Alliance, it was like, this is something that we want to see as a guidepost to try to continually strive towards. So what is the Valley Alliance? In 2005, there was a conference, the Eastern Conference Workplace Democracy, which is actually happening in Worcester, not too far away, in July 10th through the 12th. And there were a few of us hanging out saying, man, this conference is great, just like today. Wouldn't it be great to continue this energy? How can we continue to work together? So we started meeting monthly. Really spent a couple of years building relationships, building trust, seeing what we were like, how we could really address issues that are bigger than one co-op at a time. So a few years later, we incorporated as a co-op ourselves in 2011. We're member-run by other worker cooperatives. There's some numbers from 2014. So it's a relatively small system. I mean, how many workers did you have in the one that you just converted? Right, so, and there are cooperatives themselves that are, of course, way bigger than the system of 7 that we have. And then in the event, we've got over $7 million in revenue, lots of charitable contributions. A lot of the co-ops that are founded were linked to social movements or economic movements, whether it's no nukes, environmental, anarchists, certain rights. And then one of the things we like to do is advertise in movement media. So a lot of food co-op newsletters in the area we advertise in to try to basically act on that, like low-hanging fruit. Okay, you're a member of this co-op. Man, it would make sense if you were to sort of at least know about our system. So one of the things that we did to form our organization was to say, okay, so there's these other complexes and other cooperatives doing these things. How can we try to treat that as a social invention, as it's sometimes called, and how can we get our co-ops to kind of participate? And there was a larger question, what does development have to look like for cooperatives themselves to participate in and basically contribute money that's out of their own pockets? So there's a sort of a disincentive to expand or to contribute funds to other co-ops, because that's right out of, if we were a worker co-op and we said, let's join VOC, that 3 or 5% is right out of our funds, right? It's like a zero-sum game there. So it's either coming out of our co-op or out of our own members' pockets. But really, it was something where we wanted to see our model grow, and we wanted to assist the co-ops that were supporting converting or the ones that are existing. Of course, we are really lucky to be in the region of the Cooperative Fund in New England, and in fact partnered with them. We invested our fund in them as a social investment. But there are times, and we happened upon one last year, where the things that we want to loan for may be riskier. Maybe they're not smart lending, but it's something we want to do anyway. Or it's something where actually there's occasions where lenders aren't interested. Sometimes it's too small. Our goal is to really say that we're starting out small, so it's 5% of surplus for the 7 cooperatives, which is not millions of dollars, which is why it's great to be able to partner and kind of open up the world about other funding opportunities. But last year, Simple Diaper and Linen, which is one of the conversions we supported, said, we need to buy a delivery vehicle. We've been using cars. We had this other thing. It's too small. It smells. We can't use Zipcar because they think it smells when we bring dirty laundry in. Okay, yep. So you begin to see the picture. And what we did was say, okay, great, where can we go? And because it was going to be a used vehicle, it's actually hard to get, as many of you probably know, tough to get a little bit of funding to buy a used vehicle. Now, on a commercial angle, it's even more expensive because the collateral is very poor. You don't know what you're going to get for that. If it breaks down, your collateral goes right out from under you. So we were able to work with them to say, yes, you can use the VOC fund. During that, we kind of helped them with loan packaging and had sort of, as many of the other lenders here, business planning to say, hey, this isn't just a loan. We don't want to just say, hey, great, go buy this van and everything's going to be okay. We knew that there's something that you need to cover as far as understanding where this van fits in your costs. Are you adjusting your pricing? How long are you committed to these routes? When are you going to make money on these routes? Are you opening up new routes that are going to cost you money at the beginning that have an idea to return revenue soon? So it got complicated quickly. And then when they bought it, we went with them to say, okay, this is something that we want to support you with. And there's actually another cooperative, Palamato, that's a mechanic shop, and we brought one of them over to take a look at it. So, right, just to kind of try to sum up, really having cooperatives involved in some of this lending brings a unique voice. How am I doing? Is that my time?
Yep, but
Great.
you can finish your sentence.
Okay. Thank you. So it brings a unique voice to the kind of what it is, the world of lending and finance. With the funds that we try to put out, it comes with social support, a safety net that you can rely on, and business planning support. This was, when we started this fund, a lot of people said, I don't think you're going to be able to do this. Co-ops don't want to pay money to another co-op. There's already enough of that, right? There's so many dues, there's so much. But when they saw the value of being able to do it, that's what kind of got these 7 co-ops on board. Integrating development with your cooperative is a value. It's exciting to have, especially early co-ops say, hey, we had this additional capital asset we have access to. And right now, this is really small. We hope that years from now we contribute to CF&E in such a way to say, we're okay making slightly higher risk loans kind of in general, and we can back those to offer it as a collateral pool to a collateralized loan fund that sometimes is in search of that. And we thank you for your participation. That's it.
Great. Thank you.
Yeah.